It's a brilliant, brilliant event, and you'll come away with lots of new ideas and a better understanding of this incredible exponential world. You get to speak to the smartest people like you trying to figure this out, but also the people on stage. They're the experts. So we get all of that, all in one place, in Singapore. What more can you ask? See you at Token 2049.
Hello out there and welcome to another edition of Macro Mondays. My name is Mikkel Rosenvold. We are sending here from Copenhagen. With me, as usual, I have you, Andreas Steno. Welcome to the show.
Thanks, Mikkel. Good to see you.
You had a good weekend after the Jackson Hole speech on Friday?
Honestly, I spent like 48 hours trying to digest what happened. It was a big thing.
Yeah, absolutely. We'll dive much more into that. We'll have a look at, as usual, implications for Japan. We're a big Japan show, apparently. Talk a little bit about how September might look in equity markets, and also look a little bit at how major hedge funds are positioned. It's been a while since we had those charts on the show, so we'll dive into that. Andreas, I saw this meme. I want to start with this on top of the Jackson Hole speech. The Fed is now looking at cutting. People who know, people who don't know. I mean, what did you make of this Jackson Hole speech?
So I think the major shift within the Federal Reserve happened through July, especially as we saw those unemployment numbers ticking up every week, non-farm payrolls report. And ultimately, that was the clue for the Federal Reserve to shift their focus away from inflation towards trying to stabilize the development in the labor market. And they obviously have a dual mandate, so they can do so without having to sort of invent new mandates or new objectives. The big question is whether it's too early to call an end to the fight against inflation. They've obviously done so by narrowing down their focus to only employment, more or less now. Jay Powell said that they would not accept another deterioration of the labor market sentiment from here. That is a pretty firm commitment to cut aggressively should we get another spike in unemployment, which I think is very likely. We've talked about that for a month or two, that the leading indicators suggest that we get, say, at least 100 basis points higher unemployment over the next 6 to 12 months. And consider the Federal Reserve back in June posted their new central projections around unemployment. And they have a base case of 4% unemployment this year and 4.1% unemployment next year. So we're basically already past that threshold in a negative sense. And they obviously have the opportunity to update their projections in September. But I would assume, again, that they pencil in a forecast of, say, unemployment at 4.3, 4.4, something like that. They can easily be surprised on the downside in terms of employment over the next 6 months again. So I think this is a very strong hint that they will cut aggressively. I know this is a major shift relative to the sentiment we had through the first half of the year. As avid watchers of this show will know, we were firmly against that major cutting cycle that was priced in early in the year. It proved to be the correct standpoint, but now the tide has turned simply because the Fed has turned.
So explain the logic here, Andreas. Is this simply a matter of whack-a-mole? You look at inflation and unemployment, whichever number is rising, that's what you're trying to combat, or what's the logic here?
Yeah, I think that's a very simple way of looking at it, but it actually works that way. Given that unemployment is now ticking up, given that we have some pretty nasty forward-looking indicators on unemployment, it kind of makes sense for the Federal Reserve to shift their focus, especially as we've had a couple of soft inflation prints in a row. It's not like it's a home run for the inflation target yet, but we're getting there. And they're very convinced that the lacking parts of the inflation basket, namely within shelter costs and transportation costs, they will come down during the second half of the year. That's what their models are telling them. So we're basically back at a stage where the Federal Reserve is trying to look a bit ahead. And you could argue that it's about time that they do so, given the forward-looking indicators on employment. But the big question is whether inflation will flare up again next year as a consequence of this. But I mean, Mikkel, we're traders, we're macro traders, right? We're trying to get the next step right. So if inflation spikes again in a year from now, it doesn't really matter right now. For markets, no one cares. So all that matters right now is to get the next move right in dollar interest rates, the next move right in the dollar, and the next move right in Japan.
Absolutely. Get to Japan just a second. Let's just, as a bridge for that, Andreas, look at some of the forward pricing. You mentioned a little bit about the timing of this rate cut. What do you see going forward vis-a-vis how markets are positioning in future rates?
So the market has sort of honed in on 3% as the new equilibrium rate. What we have on the screen here is the SOFR rate in forward pricing, September this year, next year, 26, 27, etc. And as you can see, we approached 3% towards September 2025 already. So, I mean, the cutting cycle is very front-loaded. It needs to be. I think that makes sense, given what Powell said on Friday. But the question is whether 3% is that a fair assessment of where we'll settle? We got to roughly those levels around New Year's before repricing back to 4% in the equilibrium rate. And there's a big difference between the pricing we saw around year turn and the pricing we see now in terms of the backdrop. Because at the time, we had no clear promise on when interest rate cuts would arrive. We had no clear reaction function spelled out in terms of what they would react to. We have that now. And therefore, I think it makes sense solely from a risk premium perspective to price in more cuts than what we did in January. As we know that the Fed will cut aggressively if unemployment spikes, as we know that the Fed will cut already in September. So we basically have the reaction function spelled out just in front of us, which is a major difference to what was the case around New Year's. So let's see. I think it makes sense to continue to lean into fixed income here. We had a look, was it a month ago, Mikkel, in this show, at patterns in U.S. Treasuries around the first rate cut, and it is close to 100% hit ratio of being long brought U.S. Treasuries into such an event. Then we can obviously discuss what happens after, but we still have a few weeks of that ongoing.
Yeah. It does seem quite drastic for essentially what the markets are expecting is that we'll hit 5% by September, and then over the next 12 months, we will go down to 3%. Almost. Yeah. That seems to be quite an intensive cutting season. How should that? I know we're looking a bit further than what we usually do, but if you look at that 12-month period, what should that mean for your positioning?
I think, first of all, we probably need some 50 basis point cuts to get there, right?
Yeah, that's what I mean.
That's simple math in many ways. I think it's very likely that we get 50 basis points cuts already this year, now that they've opened the door to protecting the labor market with everything they have in their ammunition, basically. And 50 basis points is still not the base case for September in market pricing. We have roughly 4 cuts priced in for the remainder of the year, meaning that we have 3 times 25 basis points and then some sort of risk premium related to the risk of a 50 basis points cut at one of these meetings. Unemployment will tick up more than what the Fed expects it to. And that's your clue to expect a very front-loaded cutting cycle. Yeah. We had a few central banks from Europe out last week as well. I took a lot of notice from the Swedish Riksbank, basically promising to cut at each meeting for the remainder of the year, despite not a lot of stuff changing in Sweden in a negative direction, actually rather the opposite, since they met before summer. So it seems like this is a very coordinated message that we get from G10 central banks, and it's not a good idea to bet against it.
Fair enough, Andreas. Let's move to Japan. You teased a little bit about that. We can't keep that away much longer. Our go-to chart in the show over the past months, the dollar yen versus real rates differentials. We see real rates differentials dropping. Will the dollar yen trade continue that trend as well?
Well, it certainly seems so.
Yeah.
We traded dollar yen on the short side on Friday. We're still in that trade. And it was an important part of gaining some momentum in our returns around Jackson Hole. And I think it's very hard to see why that trend should suddenly stop now. You have the Bank of Japan moving rates up, albeit in tiny steps. You have the Federal Reserve clearly in the other camp now of bringing rates lower. You have a very firm direction set by both the central banks. Governor Ueda
on Friday.
Yeah, he was out on Friday as well in Parliament. And on the back of a week of exceptionally hawkish research releases in the Bank of Japan research portal. So they released a couple of papers talking about sticky wage growth, service prices being too elevated in Japan, and so on and so forth. It sounds like an echo of the Federal Reserve 12, 18 months ago. And interestingly, this is a backdrop that we've seen before towards the very end of a economic cycle, right? Bank of Japan being the odd one out in a hawkish direction all of a sudden. And all of the central banks, basically in the other camp. What's very tricky here, Mikkel, is to assess how important this trend in dollar yen will be for other markets. I've had a thesis that it will ultimately spill over to commodity markets as well. It's been correct for most parts of July, with gold not being a victim yet. And I know we've talked a bit too much about that trade, given how mediocre a performance we've seen in our gold puts. It's not like gold is through the roof, but it's been performing okay. I have to admit that. But if you look at the dollar yen trade versus equity markets, for example, I know you have a chart on the next page, Mikkel, on that. Those two trends have been very neatly correlated up until early August. So you've seen Nikkei in Japan performing, you've seen NASDAQ in the US performing alongside the dollar versus the yen trending higher. And we obviously had a major washout of positioning through July. The rug was pulled from under hedge funds in that trade. It carried spillover to levered positions in equity space as well. The question is, how important is the structural dollar yen carry trade? Because we had a washout in the non-structural trade, in my opinion. So hedge funds in and out of the trade, right? We had a washout of those, but we haven't seen a washout of asset managers, the GPIF, the government pension scheme in Japan, the biggest investor on earth. We haven't seen a washout of the Bank of Japan because they're in this trade as well. The Bank of Japan is the biggest carry trader on earth. I mean, they have a lot of dollar assets and they print yen. I mean, that's like borrowing in yen. So with Ueda telling the local pension funds to buy more at home, that's essentially the message when they try to bring down the scale of QE, when they try to bring interest rates on JGBs up. Amidst weaker returns in the dollar space, it will be very interesting to see how these Japanese life and pension funds react, because to a certain extent, they'll have to repatriate capital because of this. And that's the structural part of this equation. That's not the fast money part. That's the real long-term structural money. And that could turn the tide on a few of the very concentrated trades in the dollar space.
You want to unfuck your shit?
This is live.
Yeah, that's being recorded. Hey, listen, if you want to unfuck your future, then come and join us in the Real Vision community. Incredible platform, amazing content, some of the smartest people in the world, and amazing tools. And guess what? It'll cost you nothing. Come to realvision.com. I'll see you there, and let's help you unfuck your future.
So the thesis is that it's a goal for the Bank of Japan in a way to have these institutional investors pull money back into Japan from U.S. equities and wherever they're invested. So is this good for the Nikkei? What should we be looking at?
I'm not necessarily sure it's good for any equity index on the margin. Remember that we have other moving parts out there, but the GPIF and the other life and pension funds in Japan, they will have to take notice of what Ueda is telling them, meaning that they will have to repatriate capital on the margin relative to what they've done. And I think it's a biggie. Should dollar yen move to 130? Let's just say that. I mean, we found some sort of equilibrium around 145-ish towards the end of July, early August. And now with Powell moving the needle even further, Ueda moving the needle even further, that goalpost has moved below 140. And it's moving lower on a trend basis. So assume we get to 130, it will likely pull the rug from under the momentum in Asian macro. It's not good news for Asia is an exporting region, right? Yeah. And assuming that we get a much firmer Asian FX outlook, which is what is basically on the cards right now, that's bad news for the exporters out there. It's bad news for the economic momentum. We already have very weak forward-looking indicators from parts of the region out there, and therefore, essentially, my thesis here is that the Powell put that he basically put in place around the labor market could end up being a catastrophe for Asia, and something that will likely carry spillovers globally.
Very interesting. We'll try and narrow down the time frame a little bit, Andreas, and look ahead at September, because you did so in our weekly portfolio watch this Friday. You can find the entire article on stenoresearch.com along with all our other research. But let's just have a look at two major indicators, liquidity and China.
Yes.
And what they might mean for equity outlook in September and other asset classes. So we talked a lot about liquidity last week. You still see a very strong Q4 for liquidity, but very, very short-term looking. In September, what's the trend?
Yeah, so September is typically a pretty nasty month, both when you look at seasonal patterns. We're talking about 10 out of 10 years in a row, gold has been down, silver has been down. 8 out of 10 years, I think NASDAQ has been down most of the years in September as well. So why is that? Well, it feels kind of reminiscent of a story we also touched upon back in April, where we had some tax seasonalities pulling liquidity out of the market. And it's kind of the same pattern that we see in September. Towards mid-September, we have corporate tax payments, etc., coming in, leaving liquidity at the Treasury General account instead of in the private commercial banking system. And then we obviously have the quarter end as well, where we typically see some window dressing in the overnight reverse repo facility towards the end of the quarter, meaning that we'll get below what I call pain thresholds in the dollar reserve system towards the end of the month. It's not necessarily the end of the world. It's just on the margin, not good news. And the reason why we have such a positive Q4 ahead of us is that the Treasury General account will have to be brought close to zero ahead of the debt ceiling early next year. It doesn't really seem like anyone is doing any negotiations in the US right now. They're preparing for the election season, obviously. The Middle East is flaring up again.
Yeah. No hopes of peace right now, no.
Yeah, as I'd like you to get, now that we're talking about that September withdrawal of liquidity, I mean, what if we add war between Israel and Hezbollah here? And I mean, over the weekend, we've obviously seen attacks back and forth, but...
Yeah, so I mean, last week I had some hope that we were getting closer to a ceasefire or some sort of temporary peace in the Middle East. That was basically thrown out of the window when Israel decided to attack Hezbollah. The ceasefire talks seem to have stalled, so Israel will probably claim that they were waiting with this attack to give peace a chance, and then when negotiations crashed, they chose to attack Hezbollah. I think we will see more this week, attacks back and forth, maybe also including Iran. So that's obviously not good news for equities. Obviously not the breadth of optimism that could be brought into markets, to already volatile markets and nervous markets with a ceasefire down there. So no hopes really there. And apparently, Andreas, no hopes out of China either. We have this. I know it's tough with numbers out of China, but you have this indicator linking the Chinese GDP to the yuan out there, and you're speculating that we might see even a recession in China, despite their hopes for.
The thing about China is that we'll never really get official confirmation of whether we'll get a contraction in GDP, because we obviously had a contraction in GDP around the pandemic as well, and it was never reported. No. But a few observations from China right now. We use pollution data from some of the big industrial centers in China to assess the ongoing momentum in the export sector. Mm. The export sector has been firing on all cylinders through the first half of the year, also in conjunction with the US economy holding up, etc. Mm. That pollution-based gauge is now leveling off, meaning that you don't have that automatic tailwind from exports, probably also as a function of the US economy softening. The domestic economy in China has been terrible throughout, and it's been terrible since 2020. They're struggling to sort of refuel the credit machine. We know that, especially since 2008, they've used credit as sort of a guide for their economic cycle on a running basis. They've told regional governments to borrow and build and stuff like that to obtain those GDP targets in every single fiscal year. And now they cannot really convince households to take on new debt, simply because house prices are falling, simply because the population size is shrinking, and simply because the consumer sentiment is on the floor. And the regional governments, they're already heavily indebted. So they struggle to take more of this bad stuff on balance sheet. They've tried, but I mean, the size of these programs is not really worth talking about. So I think the only thing that can solve this is if we get a nationwide program to try and bring some of this bad debt on balance sheet for the nationwide government. And honestly, we're not really there. So if you look at M1 developments in Wang, so a relatively narrow measure of money, it's shrinking, which is something that we frankly haven't seen before. And it's not good news in an economy that is typically fueled by credit. I know there are some other liquidity gauges in China that have improved somewhat, but you should see them as a sort of reaction to tax seasonality in China. They have to add liquidity to the banking system to keep everything afloat due to tax seasonality. So I don't really see that as a major sign. So with the export momentum fading, this is not good news because the domestic economy is not there to sort of keep everything afloat.
Absolutely. So, Andreas, to sum this up, looking ahead at September, some relatively negative outlooks for the month of September. Are we looking into a weak September for equities?
Yeah, I think so. And basically across the board. I think the September seasonality will be weak in commodities and equities. Potentially, we'll get a small rebound in interest rates a couple of places, but it will not be an easy month to create returns. That's the sort of the short message. You'll have to look for clues on very heavily positioned trades that you can trade against to try and find some value here. Do I dare mention gold again? I don't think I should mention it more. No. But we have to laugh at ourselves from time to time. Maybe we should play our disclaimer when I talk about that gold trade all the time, Mikkel.
Yeah. Just a general disclaimer. All our trade ideas here, they may be.
Sometimes may be good, sometimes may be shit.
That's the way it is.
Yeah.
Very good to have that disclaimer there, obviously.
Yes. But again, 10 out of 10 hit rate of being short gold in September over the past 10 years. So let's see. I think the commodity market is celebrating a bit too early, but on the back of the Powell speech on Friday, we've seen reflation trades performing. Copper is doing it better again, etc. But let's have a look at the positioning, Mikkel.
Absolutely. We do a couple of times each month. We do this positioning watch article, which basically looks at the positioning of major hedge funds around the globe, and it seems like the fund flows indicate that these people have been buying the dip, essentially, are into positive terms. What do you read out of this?
Yeah, so I mean, the only ones selling in July were those hedge funds caught in the crossfire of this dollar-yen trade. We even saw retail piling in with a lot of ammunition into the high beta bets and risk assets. And as you can see from our flow of funds data here, we're talking about pretty sizable moves into equities, both in July and August. So we're kind of back at the flow picture we saw towards the end of Q1, where everyone was very positive. And then we had the April seasonality in taxes. And remember, we actually did get a pretty nasty drawdown in April before a rebound in May again. So I think something similar is very likely. At least the market is heavily positioned for equities to perform due to what Powell said. I'd mentioned, though, that when you see interest rate cuts of the magnitude that Powell is currently hinting towards, Russell is not the worst bet on earth. So small caps, they also performed well on Friday. Seems like they will perform well in the cutting cycle, at least relative to some of the larger companies. And I think it makes sense given that they've been complaining about tight financial conditions for a long while the Max 7s and the likes, they've been blessed with high multiples and so on and so forth, and they haven't really been heavily influenced by high interest rates. I know Raoul Powell's been very much on top of that. But I think there's a growing possibility that we'll actually get better returns in sort of the broad market now. And those CEOs, they've been mentioning on earnings calls that get those rates down, Jay. Come on, please, now. So it's about time.
Very interesting. And just finally, we also break these into, of course, we also look at the positioning into commodities, FX, etc. But we also break them down in various sectors of the equity space. Any red flags here for you when we look across sectors?
So materials is interesting, right? Because it's very heavily positioned into, and the materials equity sector is, of course, very linked to China. It's very linked to the commodity outlook. So I guess this is a sign or a warning that the market is expecting Jay Powell's interest rate cuts to sort of fuel everything immediately. I think there is some merit to that view. The issue is the word immediately. It took a long while before interest rate hikes worked. It will take a while before interest rate cuts work as well. And that's what we need to watch in the coming months. If we get a few weak labor market reports, I'm not sure that the market will take a lot of comfort in that. Having said that, Mikkel, and we stick to our guns on that, we're seeing interest rate cuts amidst some sort of cyclicality brewing. And I think that's still the case. So when we head into Q4, etc., I don't. What I'm saying here is that I don't think it's the kind of cutting cycle where you need to run for the hills. No. You need to be a little bit selective here, but it's not an 08 style crash or anything. It's not anything near that. You need to watch the ramifications of dollar yen coming lower. You need to watch the ramifications of a weak labor market, and you need to assume a time lag between interest rate cuts and when they work.
Absolutely. So to keep on top of all this, obviously you can check out all the research at stenoresearch.com, all our tactical bets and ideas for trades. You can follow Andreas and myself on Twitter for more on that. Not much left to say this week, Andreas. Been a great show. We'll be back next week with even more coverage on these topics and a glimpse into the new macro regime for the months of September.
Yeah. I think we kind of warned where things
are. I think so.
September,
people can read between the lines out there. But anyway, yeah, absolutely. Thanks a lot for watching. We'll be back next week.
It's a brilliant, brilliant event, and you'll come away with lots of new ideas and a better understanding of this incredible exponential world. You get to speak to the smartest people like you trying to figure this out, but also the people on stage. They're the experts. So we get all of that, all in one place, in Singapore. What more can you ask? See you at Token 2049.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.